All right, today we're tackling a massive valuation puzzle. We're going to dive deep into one of the biggest companies on the planet, Mobil, and explore why there are two completely different stories about what it's truly worth. So right now, if you look at Wall Street, the consensus view is pretty clear. Based on today's oil prices, their current earnings, the whole performance picture, the market has pretty much settled on a number.
And yeah, that number is right around $150 a share. This valuation is basically a snapshot in time. It's the standard, widely accepted view of what the company is worth today.
But here's the thing. What if that standard view, that simple snapshot, is missing the much bigger picture? What if it's focused on all the wrong things? Well, that is exactly the argument from veteran natural resources investor Rick Rule. He looks at the very same company and sees something totally different. He sees a value north of $250 per share. I mean, that's not just a little different. That's a huge gap. So where in the world does a number like that come from? Well, it all comes down to three key pillars that make up his contrarian case. Okay, so the first piece of this puzzle, it doesn't even really start with Exxon. It starts with a massive unfolding problem in the global oil market itself.
According to Rick Rule's thesis, this is the amount of essential investment, the sustaining capital, that the global oil industry is failing to make, and not per year or per month, but every single day. $2 billion. That's money that should be going into finding and developing future supply, and it's just not happening.
And the logic here, it's just simple cause and effect, right? Rule argues that after years of this chronic underinvestment, a future supply shock is, in his words, inevitable. I mean, think about it. You can't pull oil out of the ground that you never looked for in the first place. For him, this isn't a guess. It's just arithmetic. And that arithmetic is going to lead to much, much higher oil prices down the road.
All right, so let's move on to the second pillar. And this is where it all starts to connect back to Exxon specifically. This is all about a fundamental difference in how you value a company like this. See, the market, for the most part, is using what's called net asset value. It's like taking a photo. It tells you what Exxon's reserves are worth based on today's oil price, period. But Rule is using a net present value model, which is much more like watching a movie. It tries to calculate the value of all the cash flow these assets will spin off over their entire life.
And this is really the key concept. NPV isn't about what the assets are worth today. It's about figuring out what all their future profits are worth pulled back into a single number you can look at right now. It's a bet on the long-term cash-generating power of the business.
And this is why that NVP approach is so important when you're talking about Exxon, because the quality of their assets is just off the charts. We're talking about some of the best projects in the world, like in Guyana and the Permian Basin. These are what you call Tier 1 assets with incredibly low production costs. So low, they can fund their own growth without having to go out and borrow a ton of money.
In fact, get this. The break-even price to get oil out of the ground from their best assets is less than $35 a barrel. That gives them this massive competitive advantage. It means they can be a cash printing machine in almost any price environment, and that is something Rule believes the market is just completely mispricing.
Okay, so the final pillar of the argument, this one's a little different. It has less to do with oil barrels and geology, and way more to do with people, with investor psychology.
You'll often hear Rick Rule point out that right now, natural resources are what he calls a hated sector. Allocations from big, generalist investors are just tiny, way below their historical averages. The big money just isn't there. So here's the crucial point, right? When a whole sector is this unpopular, the prices you pay for the companies in it are just cheap. Their valuations get squeezed down, and Rule is making a bet that this trend isn't going to last forever. He's not just valuing the oil. He's valuing the inevitable return of big institutional money back into the energy sector. And think about it. When that capital does come rushing back in, where is it going to go? It's going to go to the biggest, the safest, the highest quality name in the space. It's going to go to ExxonMobil. And that would trigger something called multiple expansion, which just means investors are suddenly willing to pay a much higher price for every single dollar of Exxon's earnings.
So okay, let's put it all together. You've got the coming supply shock, you've got the world-class assets, and you've got this hate trade idea. What you end up with are two completely different visions for the future, which lead to those two wildly different valuations.
This chart really lays it all out, doesn't it? The market is looking at today's oil price, focused on quarterly earnings, and sees a whole lot of risk. Rick Rule is looking 5 to 10 years down the road. He's pricing in a future scarcity price for oil. He's valuing those long-term cash flows, and he sees Exxon as the ultimate survivor. That's how you get from $150 to $250 plus.
And really, this quote from the man himself just wraps it all up perfectly. He sees an incredibly high-quality business trading at a discount to its real, long-term potential, with a powerful tailwind behind it that he believes is pretty much guaranteed to happen.
And that really brings us to the final takeaway. The difference between a $150 stock and a $250 stock isn't just about spreadsheets. It's a bet on two completely different stories about the future of energy. One story is all about the here and now. The other is about the inevitable arithmetic of tomorrow.